couple of days ago, I got a request from an institutional client about what was my updated model for my ASX, not my ASX 200, but my S&P 500 model. And the request was in response to one of my pieces about the Federal Reserve. So today I'd like to talk about what's in that model, and that takes us, and pretty obviously the two things that are in the stock market models are earnings per share and bond yields, the two most obvious things in the world. And we also throw in corporate risk spreads, which matter when you're having a credit crunch, but don't matter most of the time apart from that. So what's actually happened in markets in the last year is we've obviously had a very significant correction. And the reason for that correction is not because there's been a dramatic decline in earnings, because there hasn't, and not because there's been a recession, which hasn't happened yet in the US. But we've had a very significant increase in US 10-year bond yields. As a matter of fact, US 10-year bond yields today are around about twice the level that they were a year ago. The last couple of years, 2020 and 21, are pretty remarkable in the history of the US long-term bond. Last month marked 330 years. I don't know if the number 333 means anything, but it was 330 years since the creation of the US Treasury bond, when Alexander Hamilton got the first bond issue passed in the House of Representatives in Philadelphia by exactly one vote to allow the US Treasury bond to occur. And the lowest yield ever in that entire 330 years was in 2020, and the second lowest yield ever was in 2021. So in fact that yields now are twice what they were last year means we were coming off an incredibly historically low base for US Treasuries. So I said the two things that are in the model are bond yields, which are up, but from an incredibly low level, and still at a really low level historically, kicking around between 2.7 and 2.8% in the last couple of weeks, and earnings. Briefly, what's happened with earnings is we hit a little air pocket in the first quarter. Earnings fell. This is in terms of operating earnings per share in the S&P 500 fell from $56.73 to $49.36. They've lifted again to $52.69, and by next quarter they're supposed to be $56.65. So they'll be back to where they were before this little slowdown in earnings began. So earnings took a hit last quarter, but now they're improving and they'll be better in future. So since the big swing thing in the model is bond yields, what's driving that kick? Well, in bond yields, at least in the short term, well, obviously something that's very important in bond yields is inflation. And as we know, the CPI, US CPI will come out tonight. And as far as bond yields, what's concerned is not what nominal yields are, but what core inflation is, that is to say inflation excluding food and energy. And very interestingly, what happened in the core CPI series is it peaked back in last March. It peaked at 6.5%, and in April it fell to 6.2%. In May it fell to 6%, and last month it fell to 5.9%. Now the most recent consensus for the CPI that I looked at just this morning is down slightly from yesterday's consensus of 6.1. This morning it's 6.0. But what that means is that the market expects that the core, the peak in core was way back in March, and that number has been falling ever since. And that's the reason, or the logical reason, why you actually had a kind of a double top in bond yields with the first run up in bond yields to try and make a peak was on the 10th of May, but the actual peak seemed to happen on the 16th of June. And if core inflation continues to fall, as consensus suggests, by which I mean not exceed the peak back in March, it's very likely that that peak on bond yields on 16 June will hold, and bond yields will continue to be around this level or a little bit lower in coming months. And that supports whatever fair value earnings are. If bond yields stay around about the same as they are now and earnings go up, then you can see that you would expect fair value for the S&P 500 to rise and the market to be generally healthier in coming months than they have been in recent months. So that brings us to the question is where is fair value for the S&P 500 right now? Well, we've got two models or two ways of looking at it, and the two ways of looking at it really result from the way US tax law runs and how it's different from Australia, from tax law in Australia. In Australia, the Australian market's very sensitive to changes in bond yields, much more sensitive than changes to than the US market is. And that's because we have franking credits and the US doesn't. And so the US really rewards, the US equities market really rewards return in growth in earnings, because that generates an increase in capital value, and most of the shareholder, the reward is taken in the US in terms of increasing capital value or after tax capital gain, whereas in Australia most of the reward is taken in terms of earnings per share after franking credits. So what that means if we run a model of just the last 12 years, we have a pretty good model for the S&P 500. It explains 93% of monthly variation of the S&P 500, and it says that fair value is 39.90, let's say 4,000 points. The market is 130 points higher than that, and that's way below a standard error. So what we can say is the market is very slightly overvalued, but far less than, say, less than half a standard error above fair value. So it's within random error. But what becomes really interesting is when I look at a longer term model, and this takes us back to the end of last century. And what actually happens is when you take a longer term view of US equities and the S&P 500, you get a much more of a, dare I say, what Warren Buffett view of US earnings, because then when you take, say, 24 years or more of data and put it in exactly the same kind of model, like this earnings per share and bond yield, what you find is the effect of interest rates almost entirely disappears and is no longer statistically significant. And the only thing that matters is bond yields. So the only thing that matters is earnings. And you wind up with a model that looks very, very much like the Warren Buffett model, where you've got the market going up and down with nominal GDP. Well, in this case, this model goes up and down with the nominal level of earnings and not much else. And in terms of that model, what the fair value of the S&P 500 is, it rises to between 4,350 and 4,400 points. So it's so the market is cheap, still genuinely cheap in the US if you're just looking at earnings, but it's slightly expensive if you're looking at earnings and bond yield. But either way, it's the S&P 500 on either model is not showing this significant risk right now. And as long as inflation, core inflation anyway, looks like it's topped and bond yields stabilise, we should have a pretty reasonable period, particularly when we get into the final quarter of this year. That's the end of my comment. Are there any questions?